Good evening all. Jai Jalaram, Jai Lohana Mahaparishad. આપણે LMP ના જે LMP CA ટેક્સ પ્રોફેશનલ ગ્રુપમાં નો જે આપણે ફોર્મ કરેલું છે સતીશભાઈ આપણા ડાયનામિક અને જે ઓલવેઝ હું કહું છું કે વિઝનરી પ્રેસિડેન્ટ કે સતીશભાઈમાં રિયલી વિઝન છે, બહુ બધી એનર્જી છે અને એનર્જી અમારામાં પોર કરતા જ રહે છે. અમને મજા આવે છે કામ કરવાની. તો સતીશભાઈ તમારા પરમિશનથી વી આર સ્ટાર્ટિંગ ધ પ્રોગ્રામ for the income tax. We have put the program of the income tax for the FAQ for a resident જે રિટર્ન ફાઇલ કરે એને જે પણ પ્રોપર્ટીના ડિસ્ક્લોઝર્સ કરવાના હોય ITR માં ડિસ્ક્લોઝર ફોરેન એસેટ અને ફોરેન ઇન્કમ રેસિડન્ટ ઇન્ડિયન જે રિટર્ન ફાઇલ કરે એની માટે જે લોકોને there are so many issues કે ભાઈ કેવી રીતે પુટઅપ કરવા, શું કરવા, બહુ બધી એમ્બિગ્યુટી હોય છે, બહુ બધા લીગલ ઇશ્યુઝ હોય છે. તો ટુડે વી હેવ સ્પેશિયલ લર્નેડ સ્પીકર CA ઉજ્જવલ ઠકરાર આપણી જોડે છે. તો એ આપણા જે પણ પ્રોબ્લેમ્સ છે એનું નિદાન કરશે. આપણને ડેફિનેટલી બહુ સારા પહેલાથી એટ ધ એન્ડ ઓફ ધ ટુડે સેશન ડેફિનેટલી people will take so many things today from this lecture. Satishbhai, now I'll request our LMP World President, Lohana Mahaparishad World President, Shree Satishbhai to give us some blessings.
Good evening to all. બધાને જય સિયારામ, જય રઘુવંશ, જય મહાપરિષદ. આપણે ભરતભાઈ, under your guidance, this Lohana Chartered Accountant Practitioners group, is doing excellent. You, the chairman, you have taken this, this particular committee to a very different level. And now it is joined, by the young people, like Khyati, Jaideep Bhai, Ujwal, and so on, And I'm really proud, and I'm so glad that, the youth, who were once upon a time, were never part of all these activities, have come forward, to take up, this responsibility. And that too, with the topics, which are very important topics. I have sent across, as you are aware, that, we are connected with about 37 countries in the world. And those people, have shown a lot of interest. Some of them said that, because of time difference, we may not be able to join. But and they have requested, for the clipping or the recording, which we have said that, we will be sharing. What I'm trying to say is that, people, who are, people really appreciate, these kind of topics. So keep doing good. They also, that, everybody is connected to India. India is making good progress. We were just about 73,000 points before the election. Today, we are about 80,000 points. It means more and more investment is coming into India. More and more opportunities are there in India. And there is no looking back. It means that, more and more people like you and this such kind of topics, would be appreciated by the people. And people are looking, for experts, who can sit abroad and, can, source them here. So this particular platform, should take, of course, Lohana Mahaparishad to a different level, but, it is really win-win situation, for those who are looking for the guidance and who are willing to give guidance. It means it's a good situation, for both of you. I wish you all the best, for this particular program. And always, Khyati, you have been doing an excellent work. We are really proud of you. And keep doing good, keep, innovative, because, all these innovative ideas really help. I don't want to waste much of your time, but I think I have covered all what I have to say. Thank you very much once again for inviting me.
Thank you very much.
On this group.
I will welcome to
on this panel.
The president of GSTPM of Maharashtra. Thank you, Praveen, for joining. Praveen Shinde for joining our LMP program. Really, Satishbhai, તેમ જે કીધું એ પ્રમાણે યંગ રિયલી સ્ટોલવર્ડ્સ આપણી સાથે રેલી જોડાઈ રહ્યા છે. બહુ બધા રિયલી આઈ એમ વેરી હેપી કે ખ્યાતિ છે, જયદીપ છે, ઉજ્જવલ છે, ગુંજા છે, એ રિયલી રીનવ ખક્કર છે. રિયલી એટલા લોકો સાથે કરે છે કે ભરતંગલ અમારે શું કામ કરવાનું છે. એટલે મને બહુ સારું થયું છે. ઓટો મોડમાં ધીરે ધીરે જઈ રહ્યું છે. હવે આપણે GST ના બી પ્રોગ્રામ રાખવાના છે. બહુ બધા હજી બધા આગળ પ્રોગ્રામ રાખવાના છે આ બધાના એન્થુજી. So we are very lucky કે આપણા સાથે young generation જોડાઈ રહી છે. With this, I request Advocate Jaideep Sonpal to give the formal introduction of today's speaker, CA Ujwal Thakrar. Jaideep.
Thank you, Varun. It's my privilege to introduce our own Ujwal bhai. We have been very close friends since we are associated in MCTC. And now it's my privilege to introduce a new forum as a speaker. So, Mr. Ujwal bhai is an associate member of Institute of Chartered Accountants of India and LLB from Mumbai University. He has more than 12 years of post-qualification experience handling various audit, direct tax, and transfer pricing matters, including 5 years work experience in Big Four firms. He specializes in the field of transfer pricing laws, audit, and taxation of charitable trusts. He has made various presentations on the topic of transfer pricing and NRI taxation at the Institute of Chartered Accountants of India, Chamber of Tax Consultants, and various study circles. Other matters, he's immediate past president of Malad Chamber of Tax Consultants. He's a committee member of International Tax Committee of Chamber of Tax Consultants from last 5 years. He has passed certificate course for being appointed as social auditor by NISIM. With this short introduction, I would hand over the dais to Ujwal bhai to begin with the lecture.
Yes.
Yes, Ujwal.
Thank you very much, Jaideep bhai, for the introduction. Thank you, Bharat bhai, Satish bhai, and everyone for this opportunity. So when Jaideep bhai asked for keeping a lecture on this topic, I readily agreed. This being one of the topics which I have been speaking for so many years. Uh, we have a lot of non-resident NRI clients, especially in our community, Lohana, most of them have settled all over the world. So it is good to meet everyone, when they come to India, solve their queries, help them and guide them on this topic. And somehow everyone or every CA has few NRI clients. So that way it is a very relevant topic, especially, when foreign assets are concerned, when they come back to India, the penalty for non-disclosure is very high. Say, it is 10 lakh rupees if you don't disclose foreign assets. So practically what we have seen is, most of the people who are non-residents, when they come back to India, generally, don't maintain books of accounts uh, for their foreign assets. Or the people who are residents generally don't maintain books like how we are maintaining when here. So I'll give you a simple example. What we have got recently is FASTag introduced in India. This FASTag was introduced uh, in abroad, say US, and also many years back. So when a person, had forgotten to disclose a FASTag account, generally a FASTag account there means opening a separate account and linking it to a separate bank account. So one person had forgotten to disclose even a FASTag account in his ITR, and they got notice saying you have not disclosed this account. So in today's world, it is so much like information sharing happening between all the countries where they are, disclosing such information to each and every one governments. And in such case, they are quickly able to get "Okay, this person is having so many accounts here and you have not disclosed the same." Uh, with this, I will like to start the presentation. So any queries as discussed with the organizers, you can put in the chat box during the session. And when time permits, we will take it at the end. My screen is visible?
Yes. Yes.
Yes.
Yeah.
So what we are going to cover today is, definition of residential status. What is the tax incidence and scope of total income for NRIs and OCIs and PIOs. Chapter 3, which is a separate tax regime for non-residents. This part, if time permits, we will take up, or we will keep more time for questions, because Chapter 3, though it is a special provision, but most of them are not taking the benefit of this. Chapter 4 is disclosure of foreign assets and income. Chapter 5 is foreign tax credit, which is very important, and most of them do ask questions on this. Chapter 6 is few FAQs which are important, and at the end we will take up questions. Practical questions are more important here, so we will try to keep more time for questions. So how do you define a non-resident? So non-resident is a person who is not resident for the purpose of section 92-93, section 168, and includes a person who is not an ordinary resident. So the term non-resident is not directly defined. It generally says the person who is not a resident is a non-resident as per the provisions of section 6.6. Also as per section 115C, a non-resident Indian. Non-resident Indian means a person, an individual being a citizen of India or a person of Indian origin who is not a resident. So main important point is he should have been a citizen of India or a person of Indian origin. A person shall be deemed to be of Indian origin if he or either of his parents or grandparents were born in undivided India. So even though few of the people who might have been born abroad, if either of his parents or grandparents were born in undivided India, he will still get the status of person of Indian origin. So with this definition, generally who would be classified as non-residents? So generally people, Indian citizens who have gone abroad for employment are generally classified as NRIs, or Indian citizens working abroad on assignment of foreign government agencies, World Banks, Indian officials working abroad, or a person of Indian origin settled abroad. These are the general examples of people who would be classified as NRIs. What is the definition and how do you determine the residential status? What are the determining factors? Say for individuals, earlier, say 5 years back, the test was only number of days of physical presence. But in the budget amendment of 2021, sorry, they brought up criteria for determining status based on citizenship also, income from sources in India, and whether the person is liable to tax. So even if a person is not liable to tax in any other country, he can still be a resident of India, depending on the conditions given, which I will cover in the next slide. So now, not only the number of days, but there are various factors to see whether an individual would be a resident or a non-resident in India. In case of HUF form AOP, the control is management is seen. So where a non-resident has his control and management, if it is situated outside India, then their status will be outside India. In case of a company, the place of effective management to be seen is important. And others, basically the control and management, where the control and management of the company lies is what is their residential status. Here we are going to cover individuals only, but this is a broad overview. This is basically the main chart of section 6, which defines the test of residence in India. So as we can see, a person is resident in India if he stays in India for 182 days or more during the previous year. So if he is more than 182 days or more, he is a straight away a resident of India. Or he is resident, he is in India for 60 days or more in the current year and he was in India for 365 days or more in the past 4 years, then also he would be a resident of India. However, this 60 days, as you can see, I have marked star. There is a relaxation in this rule. When person has gone abroad as a member of the crew of ship or is leaving for the purpose of employment outside India, then this 60 days would be replaced to 182 days. So anyone would ask why this exception? So this exception is basically, when it is more of a beneficial exception. So what happens when a person who has gone for say studies outside India or who has gone for an employment job. So what happens if only 60 days would have been the criteria, then naturally, see, when we see our friends, relatives coming back to India, if they are on job, they are on studies, they generally come for 2 months, 3 months, or a longer period. They would like to be here and enjoy with their family and friends. So if only 60 days was the criteria, they would have again become a resident. So this is a beneficial exception saying, when you have gone for employment outside India, when you come back to India for say 182 days, then it is still okay and you would be considered as a non-resident. This 60-day criteria won't apply to you. Uh, so in that case, we have to see 182 days. Obviously, then there was an amendment in 2001 where they had introduced another criteria of income greater than 15 lakh and 120 days. So what it says is, in case of a citizen of India whose total income other than income of foreign sources is greater than 15 lakhs and he is in India for more than 182 days, then he shall be a resident. If also if he is not liable to tax in India, uh, in any other territory, country by reason of his domicile, then India has the right to tax such person. So I'll give you an example. What used to happen is, say people, Indian citizens were going abroad, say, I may give you an example of Dubai, which did not have any tax. So in such cases, 182 days, what they used to do is stay outside India for more than 182 days. And this is how they used to get a exemption and it was not liable for any tax. Uh, so in such cases, not only India, but globally, all the countries have come together to and created a treaty where what they have said is global non-taxation is not allowed. People, uh, person who is has to be taxed in any one of the countries. So in such a way, India also has brought this provision that if he is an Indian citizen who has gone abroad and is not liable to tax in any other country, then India will have the right to tax that person. When is a person not ordinarily resident? So when he is non-resident in 9 out of the 10 previous years, we will take another example also in the next slides so that things are more clear to the audience. I'll just go through the provisions. Or who is a citizen of India or PIO whose total income other than income from foreign sources is greater than 15 lakhs and he is in India for 120 days or more, but less than 182 days. Or citizen of India is deemed to be resident in India under the clause 1A. So with this amendment of 2021, they brought another criteria. Earlier, there was only 182 days or more or less than 182 days. But after this amendment, there is another criteria between 120 to 182 days. And having income greater than 15 lakhs. So what was the impact of this amendment? Tried to explain in a short table. So person who is prior to amendment was a non-resident. If we stay in India is less than 120 days, then there is no problem at all. You don't have to see anything. He still remains a non-resident. A non-resident less than 120 days and less than income less than 15 lakhs, again, there is no problem. A non-resident who stays more than 120 days but less than 182 days and income less than 15 lakhs, again, no problem. Only problem is when non-resident stays in India for more than 120 days but less than 182 days and income is more than 15 lakhs. So in such a case, though he would have been a non-resident, but he is deemed to be resident but not ordinarily resident due to the definition we discussed earlier. So if a person is having income more than 15 lakhs and his stay in India is more than 120 days but less than 182 days, he is deemed to be a RNOR. And resident, yeah, if more than 182 days, then straight away resident, there is nothing to be seen. So an individual is deemed resident if he satisfies the following criteria. He is a citizen of India, has total income other than income from foreign sources more than 15 lakh, and he is not liable to be taxed in any other country or territory by reason of his domicile or residence. So these three criteria are there which we need to see. Say if he is a citizen of India, his income exceeds 15 lakhs and not liable to tax. So even if he is a citizen of India, say I may give an example of Hong Kong. So if he is citizen of India, his income is exceeding 15 lakh, but Hong Kong, there are taxes. So point C does not satisfy, so he is not liable to tax. Is not true, is liable to tax, then this condition of deemed resident was not met and therefore he would not be deemed to be a resident. So what was the impact in such case? So when a person is deemed to be resident or not ordinarily resident, then his scope of income increases. Income from business or controlled or profession set up in India becomes taxable. Only this is the extra income which he is liable to pay tax on. He loses concessional tax rates and exemptions which are only given to a non-resident. DTAA benefit would not be given where tie breaks in favor of India. Then RNOR is subject to income tax compliances like TDS. Tax officer will have a greater jurisdiction on that person. Non-resident would still liable to be transfer pricing compliance and would be subjected to GAR. So why this amendment was brought in was because the Indian government wanted to, uh, catch hold of these people uh, by having a greater access. So if a person would have been a non-resident, then Indian government does not have much rights on the same, and they cannot ask for information which now due to the deeming provision they are liable to and would be asking many questions and people would be liable to reply on the same. What are the positives? So slab rates applicable to senior citizens would be available to them. TDS would not be under 195 but under the normal provisions. They would be eligible for foreign tax credit for doubly taxed income. And once if they are deemed residents, then there is no obligation to report foreign assets ITR as non-resident. Yeah, so now if RNOR as RNOR income derived from a business or controlled or set up or profession set up in India is taxable. So what is the incidence of tax? Yeah. So in case of resident and ordinarily resident, worldwide income is taxable, irrespective of whether the income is accrued or deemed to be accrued in India or received in India. Or even if the income is accrued or received outside India, worldwide income is taxable. In case of non-resident, only income which is received or deemed to be received in India is taxable. Income which accrues or arises in India is taxable, and income which is deemed to accrue or arise in India is taxable. Only exception to RNOR is that scope of total income includes income accruing or received outside India in respect of a profession set up in India. So this I will cover with an example. Say even if the income is accrued or received outside India in respect of a business set up in India, still that income would be taxable for RNOR. What are the issues or frequently asked questions here? Whether income derived from business will include only income of proprietorship setup or income from other entities like share of profit, remuneration, dividend, etc. Also, the term derived from includes salary dividend accruing outside India earned from a business controlled in India, or whether control in India can be exercised by any resident or control should be exercised by a concerned RNOR only, and what does income from foreign source means. So as we discussed earlier, yeah. When a person is deemed to be a non-resident is, when a citizen of India whose total income other than income from foreign sources is greater than 15 lakhs. So in order to determine what income is other than foreign sources, we first need to understand what is the income from foreign sources. So income from foreign sources has been defined to mean income which accrues outside India except from a business set up in India. So examples of income which are to be included in the 15 lakh is dividend, interest income received from a resident in India, income from business setup or a profession setup in India, rental income from a property in India, capital gain on transfer of assets, and capital gain on transfer of shares. So these are the incomes which we need to consider while calculating the 15 lakh limit. Let us cover this with the help of a case study. So people are open to answer this. I will just go through the facts. CA Ramesh Subramaniam has set up a proprietary CA firm in India since 2 decades. Even though he is now settled in UAE, his office is run by the trusted employees in India, and he himself also keeps visiting India for his professional assignments. He usually stays in India between 125 to 150 days. His Indian income includes income from profession rupees 10 lakhs. He has earned interest of rupees 6 lakh on his NRI fixed deposits with SBI, Chennai. NRI interest is exempt but taxable unless he is permitted to hold NRI account under FEMA. he has earned consultancy fee of rupees 10 lakh from a UK-based client for services rendered in UK during his visit to UK. The fee was remitted to UAE bank account. His professional income, which has accrued and received outside India, will be taxable if his status is RNOR. What is the status of Mr. Ramesh Subramaniam? Yeah, anyone would like to answer? So as we discussed on the last slide, whether income exempt is required to be computed while the limit of 15 lakh. Such income should not be included because anyways, when we make a computation, exempt income does not form part of the taxable income or total income. So based on this case study, what would be the residential status of Mr. Ramesh Subramaniam? You can put in the chat box also, or if anyone wants to speak, maybe they can raise their hands. This will give a answer to me if people have understood. Because of last 2 years, there have been such amendments, so questions do become tricky. Yeah, so Mr. Hitesh Bhai says non-resident. Non-resident, but non-resident or resident, but not ordinarily resident. Yes, Paresh Bhai says RNOR. As we discussed this deeming provision, so what is the total income? What would be the total income? Say if less than 15 lakh, then there is no question at all of being RNOR. Yeah, so few have said resident, few have said non-resident, few have said RNOR.
Ujwal, someone has answered from the Tanzania
Yes,
in chat box.
yes, Mr. Vihar Kotecha.
Yeah.
He has said RNOR. So I would like to go back to the earlier table. First we determine what is his income. So if his income is 10 lakh, correct? Now he has earned interest of rupees 6 lakh on NRI fixed deposit. So NRI fixed deposit is not taxable. So whether it would be included in total income. Yeah, so in such case, it would not be included in total income if he is a non-resident. So the income still remains 10 lakh, and if it is below 15 lakh, then he would be a non-resident. Only if income is exceeding 15 lakh, then we go to the definition of RNOR. See, I will go back to the earlier table. We are falling under this criteria. When it is more than 120 days, less than 182 days, income is less than equal to 15 lakh.
Thank you, sir.
Hence, he is still a non-resident. However, if income would have been more than 15 lakh, then he would fall under RNOR category. And then, even if the income being an RNOR, professional income which has accrued and received outside India, would still have become taxable because it is in respect of a business set up in India, because this practice is due to a profession or business controlled and set up in India. However, in the current case, since income is not exceeding 15 lakh, he would still become non-resident. So many people, after this amendment were asking how shall I reduce my income? I don't want income more than 15 lakhs. I still want to visit India for more than 120 days. So this is how they used to plan. Maybe, increase their exempt income by putting NRI fixed deposits, and thereby your income doesn't fall uh, in the total income criteria. This is another example of not liable to tax by reason of residence. So Mr. A, an Indian citizen, stayed 40 days in India, 130 days in Singapore, 110 days in England, 85 days in Dubai, having income from India exceeding 15 lakhs. So what would be the residential status? He is still in India, is still less than 40 days. So whether he would be a resident. Non-resident. CA Bhagyavan Kumawat is saying non-resident. So why do you feel non-resident?
Yati, unmute Bhagwan ji, Bhagwan Kumar ji, if he wants to discuss the issue.
Yeah,
Bhagwan ji,
so
are you
he
there?
has said, stay
Hello.
is less than 120 days. Correct. But then, as we discussed in the earlier slides, what was the intention of Indian government? Though his stay is less than 120 days, but he is a stateless person. He is not a resident of any of the countries, because of the number of days being less than the number of days in any country where he would have been a resident. So as we had discussed earlier, because of this, he is not getting taxed in any of the countries. Now, since he is not getting taxed in any of the countries, what globally countries have decided, then the country whose citizen he is has the right to tax that person. Correct? So he is an Indian citizen, having not having any taxable territory. So in such a case, though he stays less than 120 days, he would still be liable to be taxed in India because uh, because he is a citizen of India. Correct. So he is an RNOR due to the deeming provisions. So I will read the case study again. Mr. A, an Indian citizen, stayed 40 days in India, 130 days in Singapore, 110 days in England, 85 days in Dubai, having income from India exceeding 15 lakhs. He was not resident in any of the above states due to the lesser stays as compared to the threshold in all the above countries. Hence, he is a stateless person and will be covered under Section 61A, and the benefit of special rate of tax will not be available to him. As a stateless person, he will also not be entitled to DTAA benefits. Citizen of India can normally be judged from the passport. So how do you determine if he is a citizen? Generally from the passport, or if as he is holding Indian passport, then he is said to be an Indian citizen. Stateless person will be considered to be deemed resident with effect from financial year 2021. Indian citizen who has not even visited India, if his income exceeds 15 lakhs, is not liable to be taxed anywhere, would still come under the tax purview of India, and he may be subject to tax based on the deeming provisions. So that is what we discussed, that the countries globally have decided that such type of tax planning is not allowed. Person has to be taxed anywhere, if not in one country, in the country where he was a citizen.
If such person is a member of, can I question now or
Yes,
because
yes.
it is linked with that? If such person is a member of crew, then what will be the case?
Yeah. So as a member of crew, what the globally they have decided is, generally such persons are also stateless persons, but there is a agreement globally. Generally, the ship which he goes consists of a flag of the country. So say a ship will have an Indian flag or ship will have a US flag. So the ship where the flag, which flag it is holding, it will be deemed resident of that country. Many times ships themselves are, outside the territorial waters of all countries for 100 days also. So depending on the flag what the ship holds, that will be the residence. So questions we may take later, right? People are putting on the chat box. Correct. RNOR, what are the RNOR issues? He will be deemed to be resident, and this provision applies over and above provisions of section 6(1). So it is a non-abstent provision. What it says is, irrespective of anything, this is what the person will be considered. So covers even persons who otherwise would have been resident or non-ordinarily resident. So even if, as per a definition, he may be uh, non-resident, but due to the deeming provision, he is deemed to be a resident. So as we discussed, even if he is less than 120 days in India, but this deeming provision deems him to be a resident, even though under section 6(1) he is a non-resident. So it is a non-obstant provision which says, irrespective of anything mentioned anywhere, this will be superseding everything. So it unintentionally covers even Indian citizens who are permanently settled abroad, but who are not liable to tax in any country as a resident. So, one question was raised that, even if he has never visited India, but still he would be deemed to be resident if his country does not tax that citizen in his country due to any of the reasons. Say many countries like Dubai or Ireland had given tax exemptions to individuals. So in such case, if he is a citizen of that country, then he may be liable to tax in India depending on the taxability of that country. However, we have seen Dubai has introduced tax recently, which is still a corporate tax, but slowly and steadily all governments are expected to introduce some taxes so that people do not the other country does not get right to be taxed to the person who is resident there. Uh, so a person, in such case, a person resident under the Act due to the new clause would end up being dual citizen or resident in most of the cases because of this deeming provision. Though he has stayed say 40 days in India and say 250 days in another country, So due to the deeming provision, he would become resident of India also, and then he would become a dual citizen. So in such case, a treaty is available between two countries, then you have to see the tiebreaker test. So how would a tiebreaker test function in case of a DTAA? Dual residency. So a person can be resident of two countries as per the domestic laws, especially in the year of departure or arrival. In this case, the residential status has to be determined by applying the tie-breaking rules. So DTAA by itself does not prescribe any rules for residency, but only resolves the dual residency issues unresolved by the primary rule. So what is the tie-breaking test given under the DTAA and hierarchy? So first step is permanent home. So where the permanent home of the person is. Second test is center of vital interest, where your family, personal, economic relations are more. What is your habitual abode? The quantum of stay, where you stay more. What is your nationality? And in the end, nationality also fails, then you have to go for a mutual agreement procedure, which is both the countries decide a competent authority, and then that authority decides whose resident that person is. So let me give you an example. This example was relevant, say, when Priyanka Chopra had recently got married or was going to get married. So when in such case she had a permanent home both in India and US because she got married there, but her parents and everyone used to stay here. Center of vital interest. Then if first criteria is not met, then the second criteria. Where are the center of vital interest? Say family, personal, economic relations. He was having vital interest, family, personal relations, both countries. Then the next criteria is habitual abode. They initially used to stay in both countries, say maybe 50-50, 180 days here, 180 days there. Then nationalities. So if he's having nationality of both countries, then generally a person will have nationality of only one country and there the test will end. But there are few cases, where a person may have two nationalities. In such a case only, then it will go to the last procedure. But most of the cases, the tie always breaks in the nationality and the case is decided in favor of the nationality. Yeah, so this is basically a diagrammatic presentation of determination of residential status, what we discussed. So let's take a case study here. Mr. Gopal Murthy is an Indian citizen residing in UAE since 2008 and in non-resident since then. His stay in India during the financial year 2021 is 125 days. His stay in UAE is 240 days. Aggregate stay in India in last 4 years is more than 365 days. He has a permanent house both in India and UAE. His wife and two children are in India for the purpose of their education and hence they are tax resident of India. He has the following income: interest on NRO deposits in India 12 lakh, interest from his profession set up and received in India is rupees 10 lakh, interest on NRE fixed deposit 6 lakh. He has earned consultancy fee of rupees 10 lakh from a UK based client for services in UK. The fee was remitted to UAE bank account. Kindly determine the residential status of Mr. Gopalan Murthy. So what would be his residential status in such a case? Yes, anyone would like to respond? It's like a similar example, but with some twist. Okay, this I was on the answer slide. Resident. Mr. MP Vyas is saying resident. Resident or RNOR. So Hitesh Somaya is saying RNOR. Anyone pending to answer? Okay, so let us go to the next slide. Correct. Yeah, so Mr. Gopal would be a resident RNOR as his stay in India is 125 days. That is more than 120 days criteria. His stay in UAE is 240 days. Therefore, he is also a resident of UAE. So he is a resident both ways. So in such case, we have to apply tie breaking rules. He is a RNOR because his income is exceeding 15 lakhs. So in such case, he has a permanent house both in India and UAE. Hence, first test of permanent home fails. His wife and 2 children also are in India. His major source of income also is in India. Hence, vital interest is also in India. Hence, second test also. Hence, under the second test, he will be treated to be a resident of India. Because though he is staying outside, but his major vital interest, family and everyone is in India. He is also earning income in India. So therefore his NRO interest 12 lakh, NRE interest 6 lakh, professional income 10 lakh as well as consultancy income 10 lakh will be taxed in India. Being an RNOR, income accrued outside India in respect of a business setup in India would still be taxable. So this is how we covered a tiebreaker test. So once a status is determined as per the treaty, resident of another country as per the treaty would lead that person to be a non-resident, leading to taxation only of for Indian sourced incomes. However, compliance requirements for residents still stand. You will have to file a return to claim the treaty relief, and you shall need TRCs of both countries to claim a dual residential status. How so many times non-residents ask, say, what is the uh, place of stay important? Is the date of arrival they come to India to be calculated in India? The date which they leave India, whether that day would also be considered in the counting of 120 days or 182 days. Most of the case, many non-residents fall in that cut to cut criteria of 180 days. or 120 days. So in that case, what would be counted as number of days? The day of arrival, the date of departure, or anything. So these are just the answers to that. That in India, wherever you are, India means India. It does not matter whether you are in Mumbai, Delhi, anywhere. As long as you are within the territory of India, that is India. Stay need not be continuous. So you may come to India 10 times, you may go back. So it is not necessary that the stay should be continuous. Stay can be even on the territorial waters of India. Previous year is from April to March. That is everyone is aware. Days of arrival in India and days of departure from India. So there are different views by different tribunals and courts in India. So few of them are in favor, which they say both the days should be counted. Few cases say, only date of departure has to be considered, day of arrival not to be considered. And what is the proof of number of days? So date stamped on the passport is generally considered to be a date of proof of arrival and departure from India. So ideally, we should avoid this cut-to-cut cases because there are contrary views of various uh, judgment. Better to have 2 or 3 days more or less as the case may be. Dual residency we have covered. This slide also we have covered. Incidence of tax is what is taxable. What is income deemed to accrue or arise in India? So income can deem to accrue or arise in India in case of these 5 or 6 categories, which is through business connection, through property asset or source of income in India, salary if the services are rendered in India, dividend, interest, royalty, fees for technical services. So in all such cases, income can be deemed to accrue or arise in India. We will go through each of the definitions in the below mentioned slides. Through business connection, property or asset or source of income situated in India. What is business connection? Business connection is defined as a business connection. So basically what I would like to say, business connection is a very wide definition as per the Indian law. So basically they want to tax each and everything as a business connection and thereby, tax that person. So I would like to say a few judgments. Business connection can arise between a non-resident and resident if both of them carry a business and if non-resident earns income through such business. Business connection may take several forms. It will include carrying a business on part of main business of the non-resident through an agent, or it may merely be relation between business of non-resident and activity of agent is also considered as a business connection. If the non-resident has business connection in India by virtue of such business connection, a portion of income which actually arises outside India will be deemed to accrue or arise in India, but only such part as is reasonably attributable to the operations carried out in India. Generally, business connection is a wide term. So as if you go as per the act, almost all type of incomes would get covered. So in such cases, only a treaty helps. Though most of the non-residents would not be interested in this because generally they don't have a business which is connected through a connected person. If we go to point number 3, if they have a business connection, then so much of the income what a non-resident earns, which is reasonably attributable, In such case, the transfer pricing provisions apply where you need to use the database. You need to do the FAR analysis, and how much income is attributed to that person has to be determined based on the transfer pricing provisions. This is a bit technical, which may not cover most of the non-residents. Hence, if there are any specific questions, I will take on this. Otherwise, we move to the main items which concern the non-residents. Few of the examples I have given to business connection is business of which all the operations are not carried out in India. The income of business deemed to accrue shall be limited only to such part of income which is reasonably attributable. Collection of news and views in India for transmission outside India does not constitute a business connection. Shooting of cinematic films in India if such non-resident is individual who is not a citizen of India, or a firm which does not have any partner who is a citizen of India. So such exceptions are given in the business connection. In case of a foreign company engaged in the business of mining of diamonds from the activities which are confined to display of uncut and unassorted diamonds. So basically, when what happens is, I'll give you an example. When most of the non-residents send us an invoice, and most of them might be aware you have to give remittances, say form 15 CACB. So in such cases, when a business income gets involved, we generally ask for a no P declaration or no business connection certificate, based on which then you apply treaty provisions, and then you issue 15 CSCB certificates to clients saying the uh, non-resident does not have a permanent establishment in India, and hence the income is not taxable to him. So this is how you determine business connection. Property, asset, or source of income. So in case where a property is situated in India, though a person is a non-resident and has never come to India, if the property is situated in India, that income will be deemed to accrue or arise in India, irrespective of whether he has visited India or not. Same is true even for capital gains. So even if he has not visited in India, his income in respect of capital gains is deemed to accrue or arise in India, and hence we, in case of capital gains, property sale, even though a person who has not visited India is still liable to be taxed in India due to the deeming provisions. Indirect transfer of assets, everyone must be aware of the Vodafone case. Though the person who bought shares never visited India or did not have any business connection in India, still, since the assets were situated in India, it was taxed in India. So capital gains will be attracted when NRI sells any capital assets situated in India, and section 195 applies, and TDS is deducted at the maximum rate. So in such cases, even if a non-resident is below 120 days, but such type of income are taxed in India, even though he's not in India. The salaries, the salary earned in India, services rendered in India, even though he is non-resident, if the services are rendered in India, it will be taxable to India. Salary payable to citizen of India who is a government employee for services outside India would also be taxable in India. Physical presence is a determinative criteria. So salary earned by a non-resident by working abroad, not accrued or not deemed to accrue or arise in India. So if a non-resident is working abroad uh, and earning the salary abroad, then his salary is not to be accrued in India. However, if the services are rendered in India, then even though he is non-resident, he will have to pay tax in India. few short stay exemptions are provided. Say if he is in India only for 30 days or 60 days, then even though he is rendered service in India, he would still be exempt under section 1066 and 1068. So it's a very short stay exemption, say less than 30 days. If the services are rendered in India, then he is exempt. In case of salary, place of payment is important. So salary for services rendered in India is taxable in India, and rest period and leave period is also to be included. Salary is taxable even though it is paid by a non-resident employer. So it does not matter if payment is being made by a non-resident. The services rendered in India is taxable in India, irrespective of who pays it. Salary is taxable on due basis from the employer or of former employer. So whenever it is due, it is taxable, irrespective of the fact it is received or not. Salary if received in India. So there was a case which says that salary if received in India in NRI account, but for the services rendered outside India is not taxable. So if services were rendered outside India, it is not taxable. Though if it is received in NRI account, for salary, the criteria is deemed to accrue or arise in India if it is received in India or if the services are rendered in India. But NRE account being a non-resident account which is deemed to be outside India, so if the salary was received in NRE account, it would not be taxable for the services rendered outside India. What non-residents have to take care is TDS on salary paid by, if paid by a non-resident, the TDS is required to be deducted even if the non-resident does not have any business setup or profession setup in India. Because he is paying to a resident, TDS is required to be deducted by the non-resident employer. If it is in the form of reimbursement or relocation expenses, then such expenses are exempt. So on this point, so even if ideally a non-resident is not allowed to employ any persons in India, except if they are having an entity in India. So most of the non-residents employ people as consultants, as such TDS liability comes on them in case of employing people in India, or they would rather set up entities in India to comply with the provisions. What do you mean by employment outside India? Now, why we are discussing all these issues is, so irrespective of the residential status, such incomes are taxable in India, which is salary, dividend, interest, royalty, and technical services. Employment outside India would mean a case where employees posted outside India, either temporarily or for a long period, and would not include case of an employee who has gone abroad for a few days. So employment, how do you define employment outside India? Because employment in India is totally taxable. Employee outside India is not a case where he has gone out for a few days or temporarily posted. He has to go out for a long period. Few case studies to justify this is he was held as a resident as traveling abroad for 218 days was in connection with employment in India and not for the purpose of employment outside India. So this company had sent employee on payroll outside India, say 200 days to understand, how they wanted to set up a factory in India. So how to set up a factory, how the plant operates. So they had sent that person outside India for 218 days, but still it was decided that he was not a non-resident because the main purpose was he was on Indian payroll, just that he had gone there to understand how the business can be set up in India. In case of ITO versus abort laboratories, when employee goes abroad for few days, though posted in India, cannot be considered as an employment outside India. In case of CIT versus Indo-Oceanic shipping, place where the contract entered is not material in determining the place of employment. So though a contract might have been entered by a foreign company with Indian person, a foreign company could be a subsidiary or a related person of India. So it does not matter if that uh, company has appointed him. You have to see the substance of the nature of employment. In case of dividend interest royalty, there are straightaway taxes given under the Act, which is interest is 20% plus applicable surcharge and cess. In case of dividend income, 20%, royalty is 10%, technical fees or services 10%. So such income earned by a non-resident in India, straight away you either take the Indian tax rates which are 20%, 10% or the treaty rates, and based on this you transfer the income to a non-resident and it is taxable at such rates as provided under the Act. Capital gains, everyone is aware. Uh, Short-term capital gains are taxed at 15%, long-term capital gains, uh, which is 10% without indexation benefit, and exemption is up to 1 lakh. So these are the same as per the domestic laws. DTA versus Income Tax Act. The taxability of the non-resident is to be examined under the Income Tax Act versus the DTAA as we discussed. A non-resident has an option to choose between the two, whichever is more beneficial. So if the Indian Act is saying dividend to be taxed at say 30%, which is the recent amendment from 3 years. Earlier, dividend income was exempt, hence there was no tax. But from the past 3-4 years, dividend income is being taxed, and it is taxed included in the total income, which is a 30% slab rate. However, non-resident has an option to choose. So as per the treaty, if the rate is 20%, so he can go opt for the 20% rate, whichever is more beneficial. So TRC is must to avail the treaty benefits. DTAA benefit cannot be allowed if TRC is of a different year. So every year the TRC is to be taken. Surcharge and cess not to be added to the rate specified under DTAA. Under DTAA, the rate is directly 10%, no surcharge and cess. Also, there is a special clause under DTAA, which is Article 24, non-discrimination clause. A non-resident can prevent discrimination under the tax laws of the host country if it appears that the local laws are discriminating between NRI and the resident based on nationality. So say for example, 1 lakh exemption, say if for long-term capital gains is not available to a non-resident. I'm just saying if, and if it is available to a resident. So in such cases, treaties between both countries give an option of non-discrimination to that person, saying you cannot discriminate me based on my residential status. If you are giving the benefit to a resident, the same benefit should be given to a non-resident. This is our important non-discrimination clause. This I will keep for at the end. Say if time permits, we will come back to this chapter as we discussed earlier, because most of the non-residents are not using this separate tax regime for non-residents. I will directly go to the important points, which is disclosure of foreign assets and income. This is one of the important topics to be covered today. So what is Schedule FA? Schedule FA and what is Schedule AL? So most of the times, non-resident says that, I am non-resident, I don't have to disclose assets. Then why anyone is asking me for assets in India? So there are two things. One is Schedule FA and one is Schedule AL. So Schedule AL is applicable to everyone irrespective whether he is a resident or non-resident if his income exceeds rupees 50 lakh during the financial year. So all Indian and assets and liabilities need to be disclosed. So what happens is generally non-resident, most of the non-residents don't have income more than 50 lakh in India. But there are few exceptions, when they have sold a property in India. In such cases, they are most of the people's income do cross 50 lakh. Then in such cases, non-residents have to file Schedule AL. Schedule AL consists of all Indian assets and liabilities, which is whatever shares you have in India, whatever insurance policies, bank accounts, vehicles, uh, uh, all these assets are required to be disclosed fixed deposit in Schedule AL, even though you are non-resident, because your income is exceeding 15 lakhs, 50 lakh, 50. Schedule FA. Schedule FA is basically foreign assets. The details of foreign assets such as foreign shares, foreign company, mutual funds, ESOPs of foreign companies. In other words, all the foreign assets held either legally as a beneficiary or as a beneficial owner should be disclosed by residents. Schedule FA is basically applicable to residents. Who is required to report foreign assets? So as we discussed, the reporting requirement of foreign assets is crucial and is to be done by residents, individuals and HUFs who are classified as residents and ordinarily residents. This requirement ensures transparency in financial interests and helps to maintain tax compliance. Schedule FA requirement: all individuals who are resident and RNOR must file FA when they hold assets outside India, including financial interest in any entity or signing authority in an account abroad. This also includes individuals who hold foreign assets as a beneficial owner or derive benefits from assets as a beneficiary. So at the start of the presentation, I gave an example that most of the people do not, being Indian residents, do not maintain accounts of the foreign assets. So this is where the problem arises, because we will see in the next slides, if you don't have not maintained accounts, then how do you pass entries of the assets? Say many would have purchased assets in 2010 and you have to disclose every year. And if you don't have accounts, then in that case, every year you will have to, do the exchange rate working, because if asset is purchased in 2010 and you have to disclose now what rate you will take, all these issues do arise. So it is very advisable to have accounts maintained for assets abroad. So fourth proviso to section 139(1), this provision mandates filing of income tax returns for residents holding overseas assets as beneficial owners, signing authorities on accounts located abroad. It also applies to those who are beneficiaries of the assets located outside India. So let me give you an example. Uh, Say a person, there was a father and a son. Father was having assets located outside India. he had also created a will outside or a trust outside India, where he had made the Indian son as a beneficiary. He had also made a will that such assets, after the death would go to the Indian person. Now, in such a case, after that, the Indian person was not aware of such things that his father had assets abroad and he was a beneficiary. In such cases, most of the residents do forget disclosure of such assets outside India. In such case, we have seen people getting notices that you have not disclosed your assets outside India because you were beneficiary of those assets. Who is required to report foreign assets? So there is an exception to the mandatory ITR filing requirement for individuals who are beneficiaries, provided the income from such assets is already included in the income of the beneficial or legal owner. So if the income is already included in the beneficial owner or the legal owner, then there is an exception where it is not required to mandatorily file ITR. So a person, even though his income is below the taxable limit, if he has foreign assets, is still required to file an ITR. However, exception is that who are beneficiaries of assets located outside India, if such income is already included, then he is not required to file. Foreign citizens, exemptions given to foreign citizens are who are classified as RNOR but have entered India on a business employment or student visa, have an exemption of disclosing foreign assets under Schedule FA. So people, who have come to India for business employment or students who have come to study, they have an exemption, though being resident, are not required to file foreign assets under Schedule FA. Foreign assets acquired during the period when the foreign citizen was a non-resident of India also not required to report as long as there is no income derived from these assets during the previous year. What are the relevant rates and period and rates for disclosure? The taxpayers are required to disclose foreign assets or income pertaining to the calendar year. So the period is Jan to December while filing the income tax returns for the particular assessment. So this entails individuals, say for the current AY 24-25, the period is 1st Jan 23 to 31st December 23. So any asset or stock acquired between Jan 24 to March 24 is not required to be disclosed. Irrespective of the slab rate applicable, you must file an ITR as we discussed. If you are having foreign asset, filing of ITR is must. What are the rate of exchange for conversion? Peak balance. The TT buying rate needs to be used on the date of peak balance. Value of investment. The TT buying rate needs to be used under date of investment. So kindly note it is the date of investment. So most of the people who are not maintaining accounts, what they ideally do is the investment, say as on December, they will put and they will multiply with the rate of say March, say December 31st and put the values. So every year their schedule FA, will keep on fluctuating, which ideally is difficult to explain. When you have made an investment, your amount on that day gets freezed and then it should not get changed. But due to non-maintenance of accounts by most of them, every year their value of investment increases not only due to the increase in value, but due to the exchange rate income also. So ideally you should have disclosed on the date of investment and not the rate as on the year end. Closing balance needs to be used on the closing date. This is for the closing balance of bank accounts and everything. What are the key information required for foreign asset or foreign account in schedules? Name of the country where the asset is, name of the foreign entity where we are having investments, address, zip code, account number of the foreign repository, status of the account with date of opening or date of acquisition of the asset, initial value of the investment, highest value of the investments, the peak balance, closing value of the investments, value of the gross interest earned or credited, amount received during the sale or redemption. So all these requirements are to be kept ready while filing Schedule FA. What are the foreign assets to be reported? So following are the foreign assets, like foreign depository accounts, which are the bank accounts, FDs, foreign custodial accounts, which are the demat accounts basically, foreign equity and debt interest like shares, mutual funds, ESOPs, foreign cash value insurance contracts, annuities, life insurance, financial interest, say, shares in companies, partnership forms, LLPs, immovable properties, any other asset, accounts of signing authorities, or a trust created in foreign countries, other income from foreign sources. Most of the times, questions asked by residents is, I always am confused what accounts should be disclosed under which head, A, B, C, D, E. So as far as practically possible, disclosure is the most important thing. See, if you do not disclose in A, you disclose in B, or if you disclose in C, as far as there is disclosure, there is not an issue. Only solution, it should be disclosed in either of the heads. We will take each of the heads in the next slides. See, taxpayers are required to report the following information in Schedule FA. Part A is foreign depository accounts, custodial accounts, signing authorities. This is the general points which I discussed: name of the country, name of the institution, account number, date of opening the account, peak balance, gross amount paid or credited. So this gross amount paid or credited, like interest dividend, should match with your computation. Whatever income, being resident, all the foreign income is taxable. So the same amount you should disclose in your computation, which should match with Schedule FA. Foreign equity and debt interest and financial interest in any entity. So name of the country, code, nature of the entity, date of acquiring, interest, peak balance. Same type of reporting requirements are there. Foreign cash value insurance, contracts, annuity. So name of the country. So basically these are all heads where reporting is required. People may have questions on this, so we will take up this in the questions. Though most of the requirements are very clear, in case you have doubts, there are always instructions to the ITR which are very clear, which they mention that under what head what should come. Any other capital asset, jewelry, vehicle, painting. So basically what we have to ensure is we should maintain proper accounts of foreign assets so that nothing is missed out. As I gave an example earlier, even a FASTag balance account which was missed due to information exchange between both countries, they disclosed that this account is held by the resident in India. So they issued a notice that you have not disclosed this account. Though the account hardly had $1, still a notice was issued. So nowadays, due to information exchange, all the countries are sharing information with each other, and missing anything is very dangerous. What are the consequences of non-disclosure of foreign assets? Uh, Non-disclosure main is penalty of 10 lakhs every year if you fail to disclose foreign assets. Non-reporting will also be considered as a willful evasion of tax and might have to face imprisonment. Also, for foreign assets, the time for reopening is 16 years. So it is a big time. So you need to disclose such details properly, or there's a chance of facing imprisonment also up to 7 years. Non-declaration also revokes your right to claim relief under a DTAA. So preventing tax evasion is crucial, but optimizing tax planning can have a significant positive impact. So, instead of many people say, I don't want to disclose this. So instead of taking such steps, you rather go and see how you plan your affairs, how you maximize your tax, reduce your tax by claiming the treaty benefits and thereby, be compliant with the laws. So both has to be balanced. Foreign tax credit. We go to foreign tax credit, which also is one of the important uh, concepts, and many people have questions in this. Why should I pay tax in both countries? On So as residents, you are liable to tax in both countries. So how do you claim credit if the tax has already been paid in another country? Uh, so meaning of What is the meaning of foreign tax credit? Treaty countries, tax is covered under the relevant. So where there is a treaty between both countries, foreign tax credit means the tax is covered under the relevant tax treaty. In case of non-treaty countries, tax payable under the respective domestic laws is the uh, foreign tax. What is the mode of payment of foreign tax? So foreign tax can be paid either by direct payment of tax, or it could be deducted by way of TDS. What is the year of availability of the foreign tax credit? The year in which the income corresponding to such foreign tax has been offered for or assessed to tax in India. So as a resident, I have to declare the foreign income in India. So the year in which I declare that income is the year in which I will be able to claim benefit of the foreign tax. Where the income corresponding to foreign tax is offered in more than 1 year, that is proportionately, then you will get a FTC proportionately. Tax against which FTC is available, it is available against the amount of tax, surcharge and cess, including MAT and EMT. Where FTC is not available, if it is interest, fee penalty, or if the amount of foreign tax is disputed by the taxpayer. What is the rate of exchange for conversion of foreign tax credit? Uh, Most of the people, ask if whether TDS is enough to claim foreign tax credit. See, frankly speaking, on the basis of TDS deducted, you can get foreign tax credit, but legally the case is, what happens is, say if there is an exemption of say $40,000 in USA. Now on your income, tax has been deducted, say you have earned $20,000 and tax deducted is say $5,000, for example. Now, if you are exempt up to $40,000, then ideally you should file your return in US and claim that refund, and not offer that income in India and thereby claim foreign tax credit here. Because if you are liable to get refund in that country, then you should claim the refund there rather than saying I have paid tax abroad and claim FTC in India. That would be a more beneficial provision, and that is what the law would say. Because if the income is exempt abroad, ideally you will get the refund there. Uh, what is the rate of exchange for conversion of foreign tax credit? It is the TT buying rate on the last day of the month immediately preceding the month in which such tax has been paid or deducted. Say for example, the month of Jan, the salary received in Jan, you have to consider the TT buying rate of December for the purpose of calculating the rate of exchange for FTC. So it is 1 month behind. What are the documents required to claim FTC? Taxpayers shall be required to furnish a statement of foreign income offered, that is the tax return filed abroad, or the tax deducted source statement in Form 67, and they should have a certificate specifying the nature of income and foreign tax deduction from the tax authority of the country or person responsible for deduction of tax, signed by the taxpayer accompanied by the proof of payment. Reporting in relation to refund of foreign taxes. So taxpayer is required to report the refund which it can be claimed. Say for example, I give you an example of where income of $40,000 is exempt. Though TDS was deducted, if a person has claimed that refund of $5,000 in that country, then you cannot claim benefit here at both places. If you have got the refund, you will not get a credit here. So taxpayer is required to report the refund of foreign taxes or on account of carry back forward of the current year losses in the overseas country which have been availed as foreign tax credit in India. Availability of credit of disputed foreign tax. So credit of disputed tax will be available only in the year in which the income is offered. So it is not that you can claim the credit if you have not offered the income. And if the taxpayer furnishes the evidence within 6 months from the end of the year that a disputed foreign tax is finally settled, the evidence of the settlement of the dispute, evidence to effect that a liability has been discharged, and undertaking that no refund of this amount shall be claimed directly or indirectly. Only in such cases will you be eligible for a foreign tax credit. What is the mode of computation? Shall be aggregate of the amount of foreign tax computed separately for each source of income from a particular country, and it shall be lower of the tax payable under the Act or foreign tax paid, whichever is lower. So it is not that you will get the full amount paid in the foreign country as uh, tax. It is the lower of the tax payable under the Act or foreign tax actually paid. So if some income is taxable at 30% in USA and 20% in India, so though you have paid 30% there, you will get a deduction of only 20% in India. Then we go to FAQs in general. So these are the basically what questions do NRIs generally ask when they come to us. Can NRI own property in India? Yes, an NRI can own both residential and commercial. However, they cannot purchase agricultural land in India, plantation or farmhouses. Can NRI operate a bank account in India? Yes, NRIs can operate NRE and NRO accounts. What is the difference between NRI, PIO, OCI? NRI is a tax status while PIO and are types of citizenship for the people of Indian origin living abroad. Are there any restrictions on investments for NRIs? NRIs can invest in most of the sectors. There are restrictions only on agricultural land and certain financial products. How can NRIs repatriate funds from India? NRIs can repatriate funds through NRE or FCNR accounts. So when they have funds in NRO account, in order to transfer funds to NRE, generally banks ask for remittance certificate. And once the funds are in NRE, they can openly and freely transfer the funds. What is the penalty for non-declaring NRI status? There is no penalty as such. However, you must either close your existing accounts or convert the same to non-resident ordinary account as soon as possible. Failure may result in legal and financial penalties. As per, it is more from FEMA angle, and TDS on rental payments received by NRIs. So this is very common question. Most of the non-residents have a property in India. So most of them, and they are rented out to local residents. Now, in such case, the non-resident is duty bound to disclose that he is a non-resident to the tenant, and thereby, tenant has to deduct tax at the rate of 30% before making a rent payment to them. So most of the tenants here do not deduct taxes, though, the NRI, from the case of NRI, there is no problem. The local resident will have a problem, but still, it is a duty to disclose that I am a non-resident, thereby you are liable to deduct tax at a higher rate, which is 30%. Yeah. So with this, I cover major presentation. How much time do we have more?
How much time do you need?
No, so as such, I have covered. There was one part. So if we want to give more time to questions, then we take questions directly. Other part was self-explanatory. Otherwise, I have covered the slide.
Okay.
I think better we'll take question answer and any live
Yes,
from
because say
viewers.
second part was more theoretical, so that way it's better to have a discussion.
Sure.
Yeah.
Should I take the questions?
Yeah, thank you, Ujwal. It was really a great, very informative session to all the viewers. And we have crossed today more than 80 viewers in this session. Congratulations, Ujwal.
Yeah.
It was very live. Still, 52 people are live. Now over to Khyati. She will take all the questions in the chat box, and she will and Ujwal will answer. And any live question also people can ask for 2-3 questions. Thank you, Khyati. Over to you.
Bhagwan Kumawat has asked this question. A person who was non-resident in AY 23-24 and his stay in AY 24-25 is more than 200 days. Now he has earned salary income in USA and also has other income in India. Whether salary earned in USA will form part of total income or no?
Sorry, this question is from
Bhagwan Kumawat. It was asked at 5:44. It's a little higher in the chat box. A person who was a non-resident in AY 23-24 and then in 24-25 he has been in India for more than 200 days.
Correct.
And now he has earned salary income in USA and has other income in India. So will the salary income that is earned in USA form part of the total income in India?
Yes, yes. So see, once you are resident, your global income is taxable. So you have to declare the income earned in USA, also in India, and whatever tax has been deducted, you will be eligible to claim a foreign tax credit here. So if any tax has been paid there, you can claim the same in India.
Thank you. Shrikant Vaishnav has this question. What is the difference between NRI and OCI holder from taxation point of view? I think you've covered a bit of it, but
Yeah, so as I said, NRI is just a status. It depends on the number of days. OCI is a person of Indian origin. So OCI, for OCI also you need to see the number of days criteria. So that is what is important. Both are not. If I may go to that question, I have covered in what is the difference between NRI, PIO, and OCI. So NRI is just a tax status. PIO and OCI are the types of citizenship status for the person living abroad. So irrespective of you are PIO or this, you have to see your status based on the number of days.
fair, fair. The next question is by Bhadresh Shah. Assessee is a citizen of India, has PR of Canada, hasn't visited India in 23-24. I'm assuming this is financial year. Having LTCG on sale of shares up to 10 lakh and STCG of 6 lakh. What is the residential status?
Yeah, so as we discussed, irrespective of your residential status, there are certain incomes which are taxed in India, which are through the assets in India. So long-term capital is derived from the assets located in India. Short-term capital gain is also derived from the assets located in India. So irrespective of your status, such incomes are taxable in India. So even though if you are non-resident, based on the number of days, you will be non-resident, but such incomes will be taxable in India. So anything specific if you want to ask, they can ask. So otherwise, this is what I believe is what was his question. And
Fair, fair. The next question is by MP Vyas. A citizen of India is a non-resident, but becomes RNOR due to income exceeding rupees 15 lakhs. And is his NRI interest also taxable? He's a non-resident, but RNOR due to income is exceeding 15 lakhs. So will his
no, so
NRI interest become taxable?
no, NRE interest is tax-free for a non-resident and RNOR. So there is no problem in that. And
Next question is by Shrikant Vaishnav. In case of issuing Form 15 CA or CB for repatriation of funds from India to abroad, to ascertain the source of his income, whether the CA can check his current year income or do CA need to check the opening balance too while certifying Form 15 CA and 15 CB?
so it is a good question actually. See, ideally, what happens is it depends on the quantum of the amount. Generally, what happens, NRIs generally want to take back the huge amounts based on the property they have sold in India. So in the year they have sold the property, if proper taxes deducted, say 4-5 crores, they will take. If it is ascertainable that it is from the current year, well and good. But if it is with respect to say we have not sold property, but they have accumulated balances all over the past few years, then in that case you will have to go back to the 3-4 years where they have filed returns and whether proper taxes were paid. So ideally, in such cases, a person who has a track record of that person will only be able to give a 15 CACB. If he has come to you as the first year and you don't know the track record, how he has earned, whether he has paid taxes, then it would be difficult for you to ascertain. You may have to go back to 4 or 5 years and see the sources of income and what the proper taxes were withheld. But if you are directly able to correlate that property is sold in this year and this is what it pertains to this amount, then it becomes simple.
The next question is by Krupa Poneri. For NRI, when to file Form 15 CACB in case of sale of property? When buyer transfers amount to NRO account or when NRI transfers from NRO to NRE account?
So when is 15 CACB required is what?
In case of sale of property, is it when the buyer transfers amount to NRO account or when NRI transfers NRO to NRE?
No, so see, 15 CACB is only required when you want to take funds outside India, correct? So now, if the person wants to transfer the money to NRE, NRE is considered as good as an account outside India. So that is why most of the banks ask for the certificate. So as long as it is staying in your normal NRO account or local account, certificate is not required. It's only when you want to take the money outside India is when it is required.
Here, Ujwal, one more extended question in this particular. If any property is sold by NRI in India, after that taxation part, capital gain and that surplus amount is there, suppose the tax is paid by the NRI and then money is taking that NRI to overseas, suppose in USA. So it is again 15 CA 50B is required or not?
Yes, yes. So 15 CACB is only when they want to take funds outside India. So if the funds are in India, then nothing is required. So it's only, I didn't get your question. It's only required once.
I understand, but
Only when he wants to take outside the country. So when he actually sells the amount and gets it into NRO, NRE, there'll be no difference. But NRE, say if he's taking it outside the country.
Oh no, NRE cannot get the amount.
NRO, say if he's taking outside the country, then you will need 15 CACB.
At the time of sale, generally you have to deduct tax at 30% of the gross amount. So that time, most of the people go for lower withholding certificate to the tax officer. That is separate. But 15 CB is only at the time of making the payment outside India. If they don't want to take the money outside India, then 15 CACB is not required.
No. My question is that suppose long-term capital gain is there. Suppose the property purchased long back and now this year it is long-term. He has sold the property offering that particular thing, and that long-term paid amount, that is tax-free amount, he can take to overseas.
Yes, why not?
So in that case, 15 CA 50B is certificate is required again.
No, so again, only at that time it is required. If he wants to take money outside India, it is only when only that time it is required. I think why again you are saying again.
But Ujwal, actually 15 CACB is when we are making payment outside India. This income is accrued in India and he is taking, am I right, Bharat bhai? If I am
Right. My question is that.
So this should, I guess, this should not have any incidence of, for 15 CACB.
So that is what I am saying. At the time of sale, nothing is required. Only if he wants to take the money outside, then only it is required.
But even if he wants to take it in his own account outside, from
Correct.
his account in India to his
Correct.
account in US.
Correct.
Okay.
So see, the main intention here is when a person wants to take money outside India, the government wants to ensure that proper taxes have been paid and then only the money goes outside.
Correct.
So if for CA is issuing, then he has to check that proper taxes have been paid, then only issues. Otherwise, if all the money goes abroad, and who will be able to catch that person once the
Correct.
money is out?
Correct.
So that is the intent.
Thank you. Thank you. Yeah.
Thank you. The next question is by Ruchita Shah. Individual has received show cause notice for levy of penalty under section 43 of Black Money Act, even though he has included foreign assets details in ITR balance sheet part, but not filed scheduled fixed asset schedule. Any case law on the same that can be used to reply to the notice?
No, so I didn't get the balance sheet because in individuals there is no balance sheet.
individual को show cause आया है as a why they should not be levied penalty under 43 of Black Money Act,
Correct.
but he had mentioned the foreign assets in ITR, the balance sheet part, but he had not filed the schedule of fixed assets separately.
No, but there is no balance sheet part in ITR in case of individuals. So where they have filed. Ideally, balance sheet is only for firms or companies, or in ITR 2 or 3 there is no balance sheet. And as far as that notice is concerned, if you still have disclosed anywhere, then there should not be any problem. But that is the problem I mentioned. Most of the times people don't maintain accounts and they forget. They must have opened account 5 years back, and even though $5 are lying, still disclosure is required. Otherwise, nowadays direct notices from black money, PMLA and ED are being received, that because such matters directly go to them. So if you want to speak, Ruchita, right?
Ruchita
You can
Shah.
speak, because I don't think there is any schedule of balance sheet for individuals in their ITR.
The next question is by CA Jayesh Popat. A person was non-resident during FY 21-22 and 22-23 and put NRE deposit for period of 5 years. Now during FY 23-24, he is resident Indian. Whether interest received on the NRE FT is taxable or remains exempt income.
Yeah, so ideally that facility is only available to a non-resident. So that is why, I said when your status is changed, you should disclose immediately. So how much is the penalty for non-declaring RT? So it is more from the FEMA angle, that once you become a resident, you should immediately close your NRE accounts and declare your status. And once you declare you are resident, then you are bound to close that account. It's only that you have not declared, and that is why your FD is still remaining under that head. So in such a case, ideally you should pay tax. First thing is you should have closed the account. If you have not closed, then the other option is you still calculate and pay tax on that amount to avoid any penalty clauses or provisions.
The next question again is by Krupa Poneri. So does a buyer has to file 15 CA-CB for payment to NRI? I think you've already answered this, but for
Buyer-
payment to NRI, 15 CA-CB you will need, right? You've answered it. The next question is by Hitesh Somaiya. A person is not ordinary resident and salaried resident in UAE. In previous year, income in India is less than 15 lakhs and stay in India is less than 30 days. Is salary earned in UAE taxable in India? I believe not, but what are your views?
No, so salary is not earned in India, right?
So the salary is earned in UAE.
Yeah,
And
so
he's
then-
not ordinary resident
no,
and salaried resident in UAE. and 15 lakhs, the income in India is less
Yeah.
than 15 lakhs, and stay in India is also less than 30 days.
Yeah, so then he is a non-resident only, no? Then nothing to worry. Only if the salary was earned in India or accrued, then there would have been any question.
Right.
But everything is outside India, then no problem.
Right. The next question is by CA Kavit Gadia. Even from NRO to NRE, do we require Form 15 CACB?
Yes, yes. So that is why what I answered earlier also, the government NRE is as good as a foreign account. So from NRE you can transfer funds all over the world without any restrictions. So what the government wants to know is before the money going outside India, they want to ensure that proper taxes have been paid. So that is what the intention is. And if a CA certifies that proper taxes are paid, then only it can go to NRE.
I had one question for Form 67. Form 67 should be filed before filing ITR or after filing? I mean, is there
Yes,
any
before.
before filing ITR?
Before.
And the credits which we have to claim, that will be under section 90 or 91?
Correct. Yes. 90.
So 90, na? Okay.
90
And that
90.
will be, I mean, that in suppose in US, their tax is mentioned in USD, right? So we have to convert that into Indian currency and we have to claim it, right?
Yes. PTM. So that form specially, has all the things. If you see that form, and it is to be done headwise. So or many people take average rate. So if you are not
Okay.
aware of the rate section wise, say head wise, then you take an average rate.
So
Say
even if their TDS is TDS is deducted, that also we can claim here, right?
yes, yes. So this we discussed actually.
Yesterday we discussed. Yeah. So if there is
Then
in the form
even
of TDS,
correct,
yeah.
correct. So see, the best way is if TDS is deducted and you are eligible for refund in your country, you should claim a refund in that country. That is what example I gave. Say just like exemption in India is there of 5 lakh rupees. Though TDS is deducted, if your income is below 5 lakh, you are eligible to get refund. Same way in other countries, there are basic exemption limits. So say even if TDS, if your income is below the taxable limit and still TDS is deducted, you file a return in that country and take the refund rather than saying that TDS is deducted and let me claim a foreign tax credit here. That would be a better approach uh, legally also, because India may still say you are eligible to get refund here there. Why you are claiming a foreign tax credit here if you are eligible to get a refund?
Okay. The next question is by Delhi. Mr. A, who is an OCI card holder, having more than 15 lakhs Indian income and a stay of 160 days in India, can he be treated as resident or will he be treated as non-resident?
Yes, so as per the definition, he will be RNOR because he is, but you also have to see whether he is liable to tax or not. So as we discussed, there are three conditions: 15 lakh, 120 days or more, and whether the country where you are staying is there tax levied in that country. If all the three conditions are there, then only you are RNOR. So depending on the country where you are, as she mentioned the country,
No,
yeah,
just
so you
OCI card holder.
no. So if it was, say, for example, Ireland where there is no tax for individual, I'm just giving an example. Then you would be liable to be taxed as RNOR in India. The three criteria need to be seen.
Right. Okay. Earlier question, Ruchita Shah has said that she understood and thank you for the depth. So the the question that she'd asked about mentioning receiving the show cause, but she's understood the answer and she's thanked you for the.
Thank you.
The next question is by Vihar Kotecha from Tanzania. Where does an NRI disclose their financial status?
Fine. So financial status. So actually there is nothing like financial status. It's just that you have to disclose whether you are a resident or non-resident. ITR form does ask for the same. So depending on the number of days, you have to say whether you are a resident, RNOR or non-resident.
He has one more question. An NRI opens an NRE account and plans to stay for 1 year in India, expects to gain from income from STCG. Who should this be reported to? Expecting less than 15 lakh from this venture. But is we staying for 1 year? So 180.
No, so 15 lakh and all these things are only for non-resident. Now, if you are resident, then all these criteria do not apply. So if you are staying here for 1 year, you would be resident, then no condition. Everything is taxable in India. It's only if you are a non-resident, and then you have to see 15 lakh, 182 days, or in India, everything is taxable as a
Yeah,
resident.
one basic thing I wanted to ask. Rebate under section 787A is not available for NRI, right?
Or rebate.
Yeah,
Rebate is available, no? Right?
that is available. Okay.
Yes, yes. And see, even if I give an example that under DTAA there is a non-discriminate clause. So whatever benefits not available to non-resident, they can still claim the same under DTAA, saying residents are getting such benefits
Okay.
under the treaty.
Right. We have come to the end of the question answer round. Does
Ujwal,
anybody else have a question that they would want to ask?
Yeah, I think Ketan by
Ujwal, these 67 જે certificates છે ને,
uh-huh.
they are not giving the proper credit in the assessment order by CPCR. I have a very bad experience with this 67 claim because I have a client who is having shares in US, and as per the treaty, the tax deduction is 25%, and they are deducting 25% TDS in US. I am filing Form 67 along with the 1048 certificate given by the US companies and all.
Correct, correct.
But the,
You are filing copy
credit
of
issue is very
ITR?
much there in CPCR. Any solution for that?
You are filing copy of the ITR file abroad?
No, there is no ITR file abroad because he is a
Why?
resident in India. He is having
No,
shares in
resident in
foreign
India
countries.
is true, but if you are earning income outside India, then you should file a return that country also. And as we discussed, if eligible for refund, take refund, or based on the return income copy, you get a credit.
But he is not a resident of US. So how can he file return there?
So why you cannot file, like how non-residents are filing in India? They are non-residents, still they are filing in India.
But is he supposed to file? That's what my
Yes,
question is.
so that actually is based on the local laws there. Like how in India we have, if your income exceeds 2.5, you are liable to file return. So same basis, you have to see that country's law. See if your income is exceeding the threshold, or if then you are liable to tax. Even if not exceeding threshold, if you want to claim refund, you can still file.
But is it not sufficient that if we are submitting proof of tax deduction, we should get that credit?
So yeah, so coming to that question, if tax deducted also is a proof, but that is why I said if you have a refund claim, it is easier to get it in that country. Now, if you have not done, you file here. So most of the officers, as you said, practically are not aware and they are not allowing. So it has happened in our case also. So we again file for, rectification.
But
One
that
or two times
rectification
it
is on and
happened.
on. This is CPC, na, because
Correct.
we can't go to the
Correct.
respective officer and CPC
Correct, correct.
understanding
So
the
that is what
situation.
even we faced.
Hmm.
They one or two times file rectification and ultimately they do not understand. Then it goes to the officer. Ultimately, is indirectly coming for scrutiny. Then the officer understands and that he is closing on that basis. But as CPC, these problems are faced. Practically, that is why I said if you're eligible for refund in that country, it's better to take refund there and close the matter rather than coming here and claiming FTC.
It will be cumbersome to file return in US, right? Because we have to consult a local CA or someone.
So that depends on your cost benefit analysis. If it is a small
But
amount,
if the rectification rights are with CPC, how can the officer rectify the order?
no, rectification, most of the time they are rejecting.
Hmm.
And then finally, 2 or 3 times they don't understand, then it is transferred to the AO. And then when it is transferred, that time,
In my case, the FEC is not transferring to AO also.
so then that request you need to make, kindly
Okay.
transfer to AO.
Okay. Okay.
Then they will do.
So that might solve my problem.
You can try CP gram also, Ketan bhai.
Yeah.
Okay. Okay. Understood.
CP gram will give a fast effect.
Okay. 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 Understood. Thank you. Thank you, Bharat bhai. Thank you, Ujwal.
So we've come to the end of the Q&A. Thank you so much for answering all the questions with so much patience. I would now request Dr. Bharatvasani to take the proceeding ahead.
Yeah, thank you,
That
CA
is what I
Khyati.
said. Someone said you were reading, but then, last second part was more of theoretical rather than this. But then I think that is why we gave more time for questions so that everyone could get it.
Okay. Thank you, Ujwal, for the superb session. Like Sachin Tendulkar, you answered all the queries and you have answered the questions of so many minds of our LMP people from start to the end in your session. Thank you very much, Ujwal. And I'll request CA Kavit Gadia to propose vote of thanks for the today's session. CA Kavit, please.
Thank you, Bharat sir, and thank you for giving me this opportunity. I think Ujwal bhai has rightly given our knowledge of his experience and all, how to define our NOR, non-resident, and how to file the ITR this tax season. So I'm sure everyone will do their respective part in this, and maybe it will be very helpful this session for the NRIs also who are from Tanzania and all, they are listening. So this will help a lot to all the chartered accountants, advocates, and tax professionals here. So thank you, Ujwal bhai, on behalf of LMP, Lohana Mahaparishad. Heartily vote of thanks to you. Thank you, Ujwal bhai.
Thank you very much.
Thank you, CA Kavit Gadia. Thank you, Ujwal bhai, for the wonderful session. Again, next year, we will keep the same session for the next financial year 25-26. With this, we are ending this session and we are keeping many more sessions like this on different subjects. And I request all the members to take the benefits. Thank you all members who attended this program. More than 80 participants were there today. Thank you all. Good night. Jai Jalaram. Jai Lohana Mahaparishad.
There is one more session tomorrow by GST PAM at Matunga. It's a full day mega seminar with exhaustive expert panel, a mock GST search, and there's a panel discussions with seniors like Janak Wagani and Kiran Garkar. So please, if anybody is interested, do reach out and take benefit of the full day seminar.
Thank you, Kathy. Thank you very much. Good night to you all. Jai Jalaram, Jai Mahaparishad.
Thank you.
Yeah, bye bye.